Hello, my name is Frank O'Brien. I'm a senior benefits educator with Wespath Benefits and Investments. This is the West Virginia Annual Conference Pre-Retirement Webinar. Last week, I had a technical error that I made in not sharing my screen for the first 40 to 50 minutes of the webinar. And this is a replacement recording of that webinar. So what we're going to talk about today is what's your retirement forecast? We're going to look at the 2025 retirement process. We're going to talk about retirement. We're going to go through each of the Wespath retirement plans: Clergy Retirement Security Program, the Ministerial Pension Plan. For those of pre-82, we will review the pre-82 plan. The voluntary plan, the United Methodist Personal Investment Plan, UMPIP or UMPIP. I will have a couple of slides that will review with you the upcoming Compass Plan that will be effective January 1st, 2026. We'll talk about the programs that we provide, certainly spend some time on life stage retirement income. We'll also talk about life stage investment management. And throughout the course of this session, I'll be bringing up EY Financial Planning Services as one of the resources that is available to you, but I'll talk about them throughout this webinar. Other things to discuss: the housing allowance tax exclusion, as well as some elements of the comprehensive protection plan, the death and disability benefits that are available, and then conclude with resources. As people begin to think about retirement, and it doesn't necessarily mean they're going to retire next year or soon, it could still be 5-7 years out, but people do start thinking about when is the right time to retire. Is this the right time to retire for those who are considering being in the retiree class of 2025? Or should I wait? And there can be various reasons as to why someone needs to wait. Certainly, in our context, it could be just the generation of retirement income isn't quite where you want it to be, but you enjoy your ministry. You enjoy the church you're at. You're just not ready yet to go into retirement appointment. It could be all kinds of reasons that have people still waiting out the time period they'll go into retirement. And then when you think about whether or not it's time for you to be ready to retire, it's also, is your spouse ready to retire? It is a change in the household. I mean, we all agree it would be for the better, but still it is a change in the dynamic of the household. And it's good to know that all parties in that household are getting ready together to go into retirement. Will I have enough income? Today, we'll go through the retirement plans. We'll talk briefly about the retirement projection and benefit access and ways in which you can start to gauge your readiness relative to income. But we'll, again, talk about EY financial planning, where it's a bigger picture look at the amount of income you want to receive, you're going to receive, an income replacement ratio. They're the group that can kind of pull all of your household stuff together and help you start to generate the numbers that can help you determine whether or not you will have enough income, or if we still need to continue to contribute more to UMPIP or stay in ministry for a couple of more years. Where will I live is often a question. That's kind of across the board as well. We hear a lot of people who are going to kind of stay where they are in the general area they have. That has been their home for a long time. Others talk about, well, they had their kids there, but they've moved on, they've had kids, so now they're going to kind of go to an area where the grandkids may be nearby, not maybe necessarily the same town, but nearby. And then I've also heard of others who have already got a plot, lakeside or near the ocean or what have you. So the where I live question is something that is just as dynamic as anything else. And then what will I do with my time? Some people will take on the hobbies that they haven't had a chance to really delve into, or maybe new hobbies that they've thought about. Photography. I play golf. I love to go swimming in the ocean or a pool, those types of things. But certainly it could be, well, you want to continue to be out there in the world socializing. So maybe outside of ministry, you would get employment in a local shop, retail area in your area, just to kind of be out and about. It generates a little more income, which isn't a bad thing, but it's really more about that out and about and socializing. And we have conversations, quite a few conversations each year about those who want to stay in pulpit supply. They go into a retirement appointment, the, let's say, administrative side, of being the pastor is no longer really in play, but still can preach and can still be within your ministry. Getting ready to think about where you are as it concerns the provisions within the Book of Discipline and Retirement. There are a few that we will review. The first is normal retirement, the normal retirement provision of the Book of Discipline. This is age 65 or 40 years of service, and or is the key word there. If you're age 62 and you have 40 years of service, you can retire under the normal retirement provision. But if you're a mid-career ministry and you only have, let's say, 20 years of service, but you are age 65 or older, you can retire under the normal retirement provision of the Book of Discipline. Early retirement is age 62 or 30 years of service, or again, is the key word here. If you're age 60 and you have 30 years of service, you can retire under the early retirement provision. If you're age 62 with 20 years, early retirement provision. But there are some considerations around the benefit from the Clergy Retirement Security Program's defined benefit that we'll review when we talk about the CRSP plan. There is the mandatory retirement age of age 72. And the 20-year retirement. It's voluntary with 20 years of service. If someone, for whatever reason, is going to move on from UMC, their ministry, or what have you, and they have 20 years of service, and let's say they're 55 years old, you can retire under the 20-year rule. A couple of things to note here. The employer-provided retirement plans, CRSP, MPP, those would not become available for someone who retires under the 20-year rule until they attain age 62, which is the early retirement age. Now, your personal investment plan accounts, what you have in UMPIP, your before tax contribution or Roth accounts, any rollovers you may have put in there, that does become available to you at that time. Here we recommend that you speak to EY Financial Planning, your own financial advisor, or tax preparer to understand the consequences of taking distributions from your personal investment plan accounts if you retire under the 20-year rule. There's certain situations you should understand relative to the tax exposure that you may see. So that's what you have there with the 20-year rule. As far as the retirement process is concerned, I send everyone an email with attachments. We did not send out the kit. I did it by email, and one of those was the retirement checklist. So here we're just kind of elevating a couple of things on that checklist, but go through that. You'll see what you need to do in advance, 120 days before, contacting the bishop, the cabinet, etc., as well as getting ready to go on to benefit access and making your elections, and even some post-election things to be thinking about. But here we'll talk about registering for benefit access. I hope you all have registered for benefit access. If you haven't, I highly encourage you to do so. You will be making your benefit elections when you're going to go into retirement and you want to start to receive that monthly income. You'll make those elections on benefit access. So if you're not on benefit access, please register. Very easy to do. Go to wespath.org or benefitaccess.org. Get to the initial benefit access screen. There's a register now button at the bottom. You go through 4 panels to identify yourself. We authenticate back and forth through usually a cell phone and a text message with a 6-string number. We see that all the time now, so you're probably used to that. And we'll authenticate that, and then you can set up your account, your ID, your password, etc. For those who are already on benefit access, great. This is a retirement account. This is something you need to be looking at all the time, every day and all, but we recommend periodically going out on there, just checking out the information that's available around your account. But every once in a while, you may make a change here or there, so you may just want to navigate around so you can still see how benefit access is set up. You want to verify that all of your personal information is correct. This is important. You want to make sure your name is spelled right. Your date of birth is correct. We're going to be looking at your age when we start thinking about annuities, right? Your spouse, we're going to get to that too, and their age. Your social security number, anything along the way that is kind of demographically about you, you want to make sure is correct, because some of that will come into play when we're looking at generating benefits. Same thing with your spouse. We're going to have survivorship type benefits that are available. You want to make sure that the information on your spouse is correct. Again, name, spelled right, the address, date of birth, social security numbers, those types of data elements you just want to make sure are correct. And then your clergy service record, you want to make sure that is correct. Due to the modifications we're making now to the benefit projection, incorporating the MPP 65%, as well as the Compass plan, the benefit projection is under modification. So we weren't able to run that job, if you will, to generate the documents to send them out. We will subsequently send them out to you when that has been updated. Clergy service record. This is a reflection of your time in ministry, your career. We do look at certain segments of that clergy service record when we're determining benefits for you. Years of service under CRSP, eligibility for the Comprehensive Protection Plan. There may be some things in the annual conference I'm unaware of that also is using your years of service to determine eligibility and maybe an amount or something like that around that. So you want to make sure your clergy service record is correct. And you can generate that on benefit access. You want to verify that your beneficiaries are correct. It's very important. If you and you're married, you and your spouse, something tragic happens to the two of you, and your beneficiaries are not in good working order, then we're not going to be able to process those beneficiaries. And it could be for any reason, but any number of reasons. But if we can't process them, we can't process them. That means that account will go to your estate, go to probate court in West Virginia or wherever you're living at that time, I imagine. Take years to cost money to come out, and it may not come out exactly the way that you intended it to. So you want to make sure that they're in good working order. Again, on benefit access, you can find out how your beneficiaries, primary and secondary, have been set up. For the current class of retirees, as well as for all those in retirement appointment, we have a dedicated carve out of our customer solutions area. It is the Wespath retirement team. This group of picture here, the group in this picture right here, are those individuals who are a carve out again in the customer service area that just deal with the day-to-day items, issues, and questions and concerns of our retirees. It's a great group of people. They truly get up in the morning to care for those who serve. This is a nice picture, a nice layout of them. You can see that the phone number is there on here as well. I will be sending a PDF version of this presentation deck, so you'll be able to get that number here and on a later slide as well. Okay, understanding your sources of income. We're going to talk about your retirement plans, like the most common retirement plans. So we're going to talk about the Clergy Retirement Security Program, the Ministerial Pension Plan, the Pre-82 Plan. We're also going to talk about your participation in the UMPIP plans or other plans. So hopefully you're all in the UMPIP, and I'll probably say this several times as well. Recall that your participation in the UMPIP is important because you're supplementing your own retirement income. So you want to get that participation up as high as you can. But in the CRSP defined contribution area, you have that 1% match on a 1% contribution that you're putting into the UMPIP. So you want to make sure you're doing that. But also other plans. And we have a slide on this later on. The UMPIP plan can accept rollovers from other qualified retirement plans of the 403Bs, 401Ks, 457s, and traditional IRAs. So just understanding where the accounts are and then the ability to generate income from them as well. You want to understand your spouse's sources of income. Spouse have a career, have a traditional pension or a 401K, a 403B that's going to generate income. I mean, generally speaking, both are going to be, you both in a married couple will be receiving Social Security benefits. So you want to understand what those are going to look like. We'll talk about Social Security soon, but you want to see what that income from the spouse and the income from you and your plans, what that's going to look like together in aggregate. Again, that's where EY Financial Planning Services can come into play. And then again, the Social Security. You have your Social Security, depending upon how the amount you're going to receive, the amount your spouse is going to receive will determine what the spousal benefit will be and the amount that may be provided or not. If you're both at a higher level of Social Security income, you want to really take a good close look at that. And the best way to do that is to go to ssa.gov and set up a My Social Security account. If you haven't done so already, go to ssa.gov. Here, it's another enrollment process. Takes a little bit longer. It's a little bit more involved because they want to make sure that you are who you are, because this is your Social Security account. So they're going to ask you questions. For example, in 1985, which of these 4 houses did you live in? In 1996, which of these 4 cars did you own? And there'll always be a none of the above that's going to be provided as well. Just, kind of, it's not really a curveball, but just if it's not there, a none of the above. So they're going to have you just kind of go through that. Then at the end of that, you can go in and you can get your Social Security statement. You'll see what you would receive if you got Social Security early, age 62 or before your full retirement age. What would your Social Security benefit be at your full retirement age? If you were born in 1960 and later, full retirement age is 67, but there's that scale. People could be 66 and 8 months, 66 and 10 months, etc., based on your year of birth. But what are you going to receive in your full retirement age? And then, if you decide to defer receiving your Social Security until age 70, what does that amount at age 70 look like? For each year that you defer receiving your Social Security, you get an 8% increase in that Social Security amount. And up till age 70, what does that amount look like? And then what would Social Security disability income look like? What would survivorship benefits look like? So you can see a snapshot of that. You and your spouse are able to do that together, and you can start to do more of that financial planning, retirement income planning, to understand the sources of income that will be made available to you. We're going to talk about Social Security and that deferral of Social Security again when we talk about life stage retirement income. So now we're going to go through our retirement plans. The first one that we're going to talk about is the CRSP plan, the Clergy Retirement Security Program, CRSP or CRISP. It is the current employer-provided retirement plan. And for someone like me who's been in this industry now for, I can say, decades, this is a very cool plan for me because it's actually 2 retirement plans in one. You have a defined benefit on that left-hand side there. That's a traditional pension. It's a formula that we're going to go through. It generates an amount that annuitizes to provide annuity income to you. Again, it's really the driver. But then there's that defined contribution account. I referenced it earlier. 2% non-matching contribution goes into your account in CRSP-DC. And if you're at that 1% of UMPIP, you're getting that 1% of CRSP, and that goes into the defined contribution account. So first, we'll spend some time speaking about the defined benefit. The defined benefit is not a balance. If you go on Benefit Access and you look for your quarterly participant statement, you're not going to see a number that represents the amount of value that's going to be generating an annuity or what that annuity would be. It's not going to be on that statement. Your CRSP-DC will, because it's an account balance, but the defined benefit is a formula, so it's not going to be there. And in that formula, we multiply 3 component pieces together. The first is the denominational average compensation, DAC or DAC. Again, we love our acronyms here in the employee benefits world, DAC or DAC. There is a retirement factor. What you're going to see, and probably have already seen, is there's 2 time frames for the CRSP-DB. First is 2007 to 13, the plan rolled out. In 2007, the retirement factor was 1.25%. General Conference of 2012 reduced it to 1%. So from post-2013 to now, it's 1% is that factor. And your credited service during that period of time. Your months and years of service that are credited to you is the 3rd variable or component in the formula, which harkens back to understanding and reviewing your clergy service record to ensure it is in good working order, because we're going to use those numbers in the formula to generate the benefit. So the denominational average compensation currently, what we do is we look at all full-time appointed clergy add up that compensation, get the total number that we're looking at, and do the division. We do it, a couple of years in advance, a year and a half in advance, to make sure that we have it in order for the calendar year that we're looking at. So for 2025, that amount is $80,297. The DAC, $80,297. But at General Conference of 2024, a provision was passed that from 2026 on, we're just going to be adding 2% to that DAC going forward. So 2% off of that 8297 will be 2026, and 2% off of that will be for 2027 and so on. Again, the retirement factor is 1.25%. This is July 1st, 07 through December 31st, 2013. And then for today's purposes, we're going to be looking at June 30, 2025 as kind of our time frame for examples and modeling purposes. So here you can see that even though the factor is the factor, we're looking at January 1st, 14 to June 30, 2025. That factor is 1%. And then the credited service in that time frame, 07 through 13. What are the months and years of service? In our model, full-time appointed clergy, 7 years if full-time. And then full-time appointed clergy post-2013 to June 30, 2025 is 11.5 years if full-time. And again, we assume full-time. So we have the three component parts, we have the two time frames, and now we're just doing the math. So on the left-hand side, you can see we have the denominational average compensation for 2025. We multiply that by 1.25%, and then the 7 years of service, come up with an amount, divide by 12, and start off with a benefit of $585 a month. Then we go to the second time frame. We have the same DAC of 8297, now with a factor of 1%, and here 11.5 years of service. Multiply that, come up with an amount, divide by 12, and we end up with $769 per month. Add them together, and the benefit is $1,354. However, that isn't necessarily going to be the amount of monthly income you're going to receive because of the choices that you're going to have when you're making your elections to receive your CRSP defined benefit. First off, there's a surviving spouse benefit. And actually, there are also 3 single life annuity benefits that will be available to you. The annuities have an annual cost of living adjustment or COLA that attaches to the annuity. That percent, the annuity goes up that percent each year. For the CRSP plan, it's a minimum of a 2% COLA, but you can do 2, 3, 4, or 5%. And then also early retirement. And I say there's some considerations around the CRSP DB and the early retirement provision of the Book of Discipline. When we get into the ministerial pension plan, we're going to go deeper into the annuity types and the COLA percentages, but still recognize that those will come into play relative to the amount of income that you would receive. So we have 3 life and survivorship annuities, and again, I'll review 3 single life annuities, and you'll go over the life and 100, 85, and 70% annuities. As far as the COLA is concerned, there's some thinking, some planning to do, financial planning, retirement income planning, and tax efficiency planning for clergy. We will be talking about the housing allowance tax exclusion. So when you're thinking about the COLA, you don't necessarily have to say, hey, it can go up 2%. Because of various elements in your life and what you expect in your planning and your health and longevity, all of that, you maybe have an age gap between you and your spouse. There could be reasons why a different COLA, a higher COLA, may make more sense than a lower COLA. So we'll go through that as well. But these are some decision points that you have. And then early retirement. With early retirement, you have normal retirement at age 65, and then an early retirement of age 62 or 30 years of service. For those who retire under the early retirement provision of the Book of Discipline, there is a 0.05% in the reduction in the amount of annuity that you are going to receive. That annualizes out to 6% per year. So here we have an example of Reverend Wesley. Reverend Wesley is exactly 63 years old on 7/1 of a given year. He does not have 40 years of service. We generate that amount of $13.54 as the annuity, but then 2 years, 6% a year becomes 12%. We reduce the annuity down by 12%, and it nets out to that $1,192. Now, this is not like a penalty or anything like that. It's just actuarially speaking, we're reducing the amount because you're starting early, but you're getting the same overall benefit over the long haul. Same idea they do in Social Security. If you go out early, you get a reduced amount, but overall the benefit to life expectancy would be, the same. So it's the same kind of principle here. So you have that reduction, you have the $1,192. And for some, that might be fine. That's going to work into their financial planning. They can do that. But I just want to let you know that you can actually wait on taking your CRSP DB annuity until you attain age 65 or 40 years of service if it happens faster, and then take out the annuity and get the full amount calculated as of that age 63 retirement date. So the retirement factors are the retirement factors. We freeze your months and years of service, 7, 11.5, and we know what the DAC was for 2025 here in our example. So it's still going to start out at that $1,354. Whatever COLA you attach to it will stay with that annuity into the future. So you have the option there. If it's kind of not a big deal, you want to just start getting that benefit, you can do that. If you want to defer till age 65 or 40 years of service, you can do that. But you don't have to wait. If you go into it in this example, Reverend Wesley decided that's what he was going to do, or Reverend Wesley was going to do. Then a year later said, nah, I should probably get that annuity. Reverend Wesley can go ahead and get that annuity. Then we'll just do the reduction back from that age 65. So you have that option available to you. And really now what you're starting to get the sense of is that you have a lot of flexibility. There's a lot of options and elections that you can make that really can fit your overall household circumstances. And you're going to hear more and more about that. So it kind of becomes a bit of a fire hose as we go through all of this. So the more you hear this, the more of these events you attend, either in person, virtually, or just listening to the recordings, the more you'll get out of it. So kind of like the marketing theory of you got to hear something 7 times before you start to hear it. So we highly encourage you to continue to take advantage of the resources here. But the good news is a lot of options, a lot of flexibility to help you really tailor something that makes the most sense for you. Then we have the CRSP DC, the defined contribution account. Again, it is funded by 2% automatic non-matching and then 1% in UMPIP. Hopefully you're doing more in UMPIP, but at least the 1% to get that additional match. It's an account balance. It's in the Wespath funds. If you're comfortable investing your investment funds on your own, you understand asset classes and the markets, you kind of watch it, you enjoy it. And I've been doing this a long time, so I do. You can self-manage your accounts. So you can determine what funds you want to put in at what percentage and how you want your ongoing contributions allocated. Or you can use Life Stage Investment Management, program that we have where you're asking us to tailor the investment allocations for you over time. And I'm going to get into detail on Life Stage Investment Management later, but basically you're having us manage that investment allocation for you over time. It applies to the allocation of your accounts as well as ongoing contributions. In retirement, it becomes available as cash distributions. What's going to happen is on the CRSP side, we were able to set it up legally when this plan came into effect that once you make your benefit elections for the defined benefit, you're going to receive your annuity, you go into pay status of that annuity, we automatically roll over your CRSP DC into the UMPIP. And once there, again, it's available for cash distributions. Program we have, Life Stage Retirement Income, is a program where you're asking us to derive the amount of monthly installments and monthly income we can provide to you from those account balances. You'll hear more about this. Or, like with investment allocation, you can self-manage. You can defer it till a later date before you receive any of the income. You can set up your own monthly installment program. You set up on the original election screens. You can continue to do that through BA or call our retirement team. Say, I was doing $1,000 a month. I'm good for $900 this year or a month, or $1,100 per month for this year. You can make those options. That flexibility, again, is with you. You can defer receiving your account balances as monthly income until you attain your required minimum distribution. We have a couple of slides on this on the back end of today's presentation. But here you get to a point where the IRS says, hey, you're not taking any distributions from these accounts. You've been deferring them long enough. They have been deferred on a tax deferred basis. It's now time for you to start taking minimum distributions to generate some tax activity for the Treasury. But remember, you have that housing allowance tax exclusion. So even though it's taxable on the front end, with the housing allowance, it may not be taxable at all, some or all of it. Remaining balances in your account balances, your CRISP DC in this context, will go to your named designated beneficiaries once you and your spouse are gone. So again, keep them in good order. The next plan that we're going to refer to is the ministerial pension plan. This was the plan that was in place before the Clergy Retirement Security Program. It is an account balance plan. 11 or 12% of your plan compensation back at the time it was the active plan was going into an account in your name, invested in the Wespath funds. Here, everybody is using this life stage investment management program where we're allocating the investment accounts for you to get you to, into, and through retirement. When you go in, upon commencement for benefits, you want to start to receive your benefits, you have several options here as well. Up until General Conference of 2024, 65% of your account, if you wanted to start to receive benefits from your NPP account, 65% of that account, you had to get in the form of an annuity. We're going to review the annuities shortly. You had to get it in the form of an annuity. Well, General Conference, we passed the resolution that said, actually, with that 65%, let's give a second option using life stage retirement income as the means to generate that monthly income over time. So it's going to be either the annuity or life stage retirement income, but that 65% is still going to be providing income to you, right? It's an employer provided plan with the intention of providing income in retirement. But at 65%, you have that additional 35% that becomes an account balance that you can determine how, when, and how much income you want to derive from it. Unlike CRSP DC, where we automatically roll it into the UMPIP, here in the election screens, you're going to get an area where it's going to say, hey, hit a checkbox. When you hit that checkbox, then we're going to roll over that UMPIP 35%. I mean, I highly recommend that you do that. I'm not giving you any advice and guidance as to what to do with it thereafter, but it's easier, it's cleaner if you take it and put it into UMPIP. Really, your options, your flexibilities, in terms of the benefit elections that you're going to be making, they live in the UMPIP plan. The MPP plan, it doesn't really work that way. So you're better off rolling it over into UMPIP and then making decisions from there. But you have 100% right now in active ministry. That's your MPP account. You can see it on your statements. You can see it on benefit access. You start to receive benefits, 65% will go to either get an annuity or through life stage retirement income, and that 35% to UMPIP. And then you can determine how, when, and how much income you want to derive from that. We're going to review 6 annuity options, 3 life and survivorship, and 3 single life annuities. And then with MPP, there's 5 COLA options because a 0% COLA is available in MPP. So again, to reiterate, you have option number 1 for that 65%. You can get that in the form of a lifetime annuity, which is simply a series of payments, in our world, a series of monthly payments that will be provided to you, and if married, you and your spouse, until you both have passed. And once you both are gone, there is no further benefit to anyone else. This is the annuity. Option 2 is now using life stage retirement income, where we're doing the calculation behind the scenes to determine the amount of monthly installment payments we can provide to you. And I'll get into detail, but the way it works is similar to an annuity. It's not exactly an annuity, but we're applying the principles of an annuity, where we're giving you an amount with a recalculation done each and every year to determine how much we can give you as an increase going forward year over year to help you keep pace with purchasing power. And again, we'll get into that a little deeper later. Here, the 65%, once you decide this is how you want to receive it, you can't change your mind down the road and say, you know what, I'd rather go back to the annuity option. You're going to stay with life stage retirement income. But here, you and your spouse pass, and there's anything remaining in that MPP account, it will go to your named designated beneficiaries. The 35% is an account balance that's available to you. Again, you just got to hit a trigger, get it into UMPIP, and then you can use life stage retirement income for just these account balances, as well as other distribution options that will be made available to you. Now we'll spend some time looking at the annuities. So the MPP and the CRSP have the same annuity types that are available to you. CRSP is that formula benefit. The MPP is the account balance. You go into retirement 630 to 71, 65% of that goes and buys or purchases that annuity. Our model here did run through the annuity algorithm with our actuarial team. We just came up with a sample participant. So this is nobody's actual record or an average amount that applies to people or just what we're trying to determine. None of that. It's just an example. Clergy person 65, spouse 65, $400,000 balance, some, maybe some other things happening behind the scenes. But basically, we took that, ran that through the annuity algorithm. We came up with the 6 annuities that we're going to show you. So here you can see the 3 life and survivorship annuities. On the left-hand side, the type or form of annuity available. You can see the life in 100%, life in 85%, life in 70%. Life in 70% is considered the normal form with a 2% COLA. Most people actually do get this, but a lot of people also go for the life in 100, not so much the life and 85. But whatever works for you, that's what works for you. So there's no right or wrong answer here. You have a life in 70, you go into retirement, you pass away, 70% of that will go to your surviving spouse. So what you're seeing here is that the amount payable to you is what you would receive, and upon your passing, that's what's payable to the contingent annuitant. They both aren't coming out simultaneously. By virtue of observation, you can see the life in the 70%, it's the highest amount that's coming out to you, $1,235. And you can see that the higher the survivorship percent that you go, the lower the amount to you as payable to you, but the higher the amount that goes to the contingent annuitant. So again, I think, somewhere in the neighborhood of 70% of our participants will do life in 70%, and then a lot of participants will do that life in 100%. And I just think it's a level of comfort in the planning that they do, that they know the dollar amounts are going to be the same, not just in the initial setup, but as you both go into retirement. So 3 forms of life and survivorship annuities. The life and percentages are there, the amount payable to you, and then what the consequence is upon your passing to your contingent annuitant. With the single life annuities, you have 3 here as well. And the first is life only. And you can see here the numbers are kind of going down top to bottom, where on the other page they were going up top to bottom. The most a person would receive is a life only. It's $1,395 in our model here, because this annuity is only on one life. And once that individual passes away, there's no further benefit to anyone else. But we recognize that people who are single still may have someone in their life that they're looking after, they care for, they're trying to provide some financial support for. And if they were unfortunately to pass away early in retirement, well, then instead of that benefit stopping, there'd be a period of time where some benefit would be provided to that important person named designated beneficiary. So the first period of time that we have is a life and 5-year period certain window. So basically what happens here is you go into retirement, and in year 3, something tragic happens. And for the remaining 2 years, that named beneficiary will get that benefit. And then after the 5 years, no further benefit to anyone else. The 10-year window, 10-year certain, is the same concept. You're moving along, you get to year 7. For the remaining 3 years, your named designated beneficiary would receive that benefit. Then after that 10 years, no further benefit to anyone. If you yourself elect the 5-year or 10-year period, certain window, and you live past that, you surpass that time frame on your own, and you pass no further benefit to anyone else. So we provide, again, that flexibility to you. And then an added level of flexibility we provide is for those who are married, a single life annuity option is available to you as long as your spouse signs a waiver and consent form waiving their rights and privileges under the plan for the annuity. And again, this is where in-depth financial planning, retirement income planning comes into play. I mean, it's sad to say, but there could be health reasons why something like this may make sense. Or again, age gaps between two spouses where something like this may be a better option than the life and survivorship annuities. So this is where that analytics comes in. I keep saying it, EY financial planning, your own financial advisor and tax consultant can weigh in and help you think through these items. So 3 life and survivorship, 3 single life annuities. But then you also have the annual cost of living adjustment, or COLA. And for the MPP, you can actually use 0%, but as I indicated, for CRSP, it has to be the 2%. But for MPP, you can do 2, 3, 4, or 5%. And then that raises the question, does the COLA I elect impact the initial benefit that I will receive? And the answer to that is yes. And we're going to illustrate that here. So these numbers on the left-hand side and the ages on the bottom, again, are just for modeling and example purposes. This is no one person or aggregate average of individuals or anything like that. It's just illustrating to you how the COLA interacts with the amount of benefit that you receive going into retirement and then through retirement. So we're going to start with that normal form of benefit for a life and survivorship, 70% annuity with a 2% COLA. We have this purple line that's moving through, doing exactly what it's supposed to do, going up 2% per year. But you've sat down, you've done some financial planning, and you say, you know what? On my MPP annuity, I'm going to go for that 5% COLA. So what happens here is the amount of the benefit that you get is reduced, and it's reduced a good amount. Now it looks, I don't know, on a model, it looks like about $600, but it's reduced down a good amount. But you get out, let's say 12, 13 years, and on a monthly or annual basis, your income increases and exceeds the amount of that 2% COLA going into your mid and outer years of retirement. And that's due to the compounding effect of that higher COLA percent. So you can see that orange line is going up, that 5%, and then boom, 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 there you go. You're receiving more as you get into later, mid and later years of retirement. For the ministerial pension plan, you can do a 0%. It's the highest amount you're going to get as the annuity going into retirement, but it's a fixed annuity. It never goes up at all. I think this was a prior, like a couple of decades ago, version of what a Social Security bridge might look like. Get a higher amount out of MPP going into retirement, defer Social Security, get the higher amount. I think that was the principle behind that. And then for illustrative purposes, we say, well, if you want to do a 3% or a 4%, what would that look like? And again, relative to that purple line, the higher the COLA percent, the lower the amount to you. But the more you get later on in retirement, due to the compounding effect of that higher COLA percent, that gives you more income in retirement. You can choose a COLA percent for the CRSP, DB annuities. You can choose a different COLA percent for your MPP annuity. You can choose different annuity options under the CRSP and the different annuity form, option type of annuity under the MPP. So again, options, flexibility, dials to turn, however you like to think about that, in terms of how and when you make your elections, what makes the most sense going into retirement, and then how does that picture look going into the outer years of retirement. Coming back around to MPP, other considerations, you can leave it in the account until age 73. I'm going to hit these kind of all in a row here and go through this. So what you can do is you can defer receiving your MPP, leave 100% of that invested in the Wespath funds, life stage investment management. Your history tells us the accounts will continue to go up, maybe not every year, but over the course of time. But then you've deferred it long enough. The IRS steps in and says, okay, we got to start getting some required minimum distributions. Depending upon your year of birth, will be your age that you are required to start receiving, and I have a slide on that later on. Now, with the 65%, you now have two options. You can take that annuity, or you can take life stage retirement income. And again, once you decide which way you're going to go, what direction you're going to go in with that benefit, that stays as it is throughout your retirement. But when you're going into a retirement appointment, given whatever circumstances may be in your household, your financial planning, or even market conditions, when you think back to the pandemic year and all of that, when you go in, you can actually bifurcate out that 65% and say, you know what, I'm going to let that 65% stay invested as it is and wait till receive that benefit later on. But that 35%, I want to roll that into the UMPIP. And then I'll generate some income out of that combined UMPIP account, to keep me good and steady on my monthly income stream, my monthly cash flow over time until I'm ready to go get either that annuity or that life stage retirement income from the 65%. So you can do that, and you can take the annuity and out of that 65% or the life stage retirement income, roll the 35% into UMPIP and defer that. So again, you're having different options in the way you can do that. So right now, pre-retirement, it's all together. But once you're going into retirement, you can think about them actually as two different pieces, two different buckets, and how you want to address those buckets separately. Again, tell us to roll over that 35% into UMPIP, and then from there, all choices are yours. And there are other distribution options that are available. We'll kind of walk through distribution options at the end of the UMPIP, I think, and then we'll get into life stage retirement income subsequent to that. And then quickly, we'll go through the pre-82 plan. I'm sure there's still individuals maybe that were not a part of this particular pre-retirement session, but have pre-82. Basically, pre-82 provides a lifetime monthly benefit to participants. It is based on two calculations. So just to take a step back, when the pre-82 plan, and I think it was called the Minister's Reserve Fund at that time, because it was the active plan, for many people, and for many annual conferences, but not all, the annual conferences or employers therein were providing an amount in an account in the Wespath funds invested in life stage investment management, and that account was intended to grow and provide that future benefit in retirement. Well, that account has remained and it has grown over the course of time. So when we look at the lifetime monthly income and like going through the whole annuity algorithms to determine what the amount of monthly income would be, we're now looking at two different things and two different calculations. The first is the original or traditional calculation that was in the plan, which was years of service times a past service rate. So right now we're looking at pre-82 years of service. So again, those long tenured in ministry, you want to make sure your clergy service record is in good order. You have those years. And then the annual conference, most years, I don't want to say every year given fiscal reality, but the past service rate does go up. So right now, the past service rate for West Virginia is $651. But now we're looking at this account balance with the fancy name of defined benefit service money, right? It's the account balance that's there. And we're looking to convert that into the annuity and see what annuity can come out of that calculation. And here are examples of calculations that have been provided. So our example here, it's Reverend James, is 2 years of service, 651 past service rate, come up to that 1302, divide by 12, it's $108.50. And this is not an uncommon thing. We're looking at an account balance that may have been not all that much on 1981, but now it's worth, let's say, $75,000. Run that through the annuity algorithm, and what do we get? $2,400 annualized, divide by 12, $200 a month. Again, this is just an example for illustrative purposes. Now, we're not asking you which of these two amounts you want to receive as the benefit. We're going to give you the greater of the two benefits. So we'll give you the $200, and that'll stay $200 as a benefit through retirement. However, maybe not necessarily so. At the end of each year, I believe in November of each year, once the past service rate has been updated by an annual conference, We recalculate the amount. We'll redo that first calculation, determine if the past years of service plus the new past service rate gets you to an amount over $200. So let's say 15 years after retirement, that past service rate, it ends up being $205 using that calculated amount, years of service, past service rate. Well, we're going to switch it out and we're going to give you that $205. So going in, I've never really seen the past service rate calculation be greater than the defined benefit service money one, but we'll always look at it each year, make the determination as what to provide. And if that initial calculation exceeds that secondary calculation, we'll provide for you that higher amount through retirement and keep calculating that throughout the course of time. Lifetime monthly income, single life, no refund, no other options available, just on that one individual, benefit ceases upon death. And then West Virginia, it's life and 70% to the surviving spouse, so it's a life and 70% survivorship annuity. Clergy person passes, then that person, the surviving spouse, gets the 70%, and then when both are gone, no further benefit to anyone. And it has to be a spouse at the time of going into retirement appointment, not a subsequent spouse, and you try to recalculate the amount after that. And now we'll spend time on the UMPIP, the United Methodist Personal Investment Plan, or UMPIP. What is it? It is a defined contribution plan. It is a qualified 403B retirement plan. 403Bs live in the not-for-profit world, where 401Ks live in the for-profit world. It's an account balance plan. You have the option to self-manage your account in UMPIP or use life stage investment management. The plan is structured in such a way where, and it can be structured in such a way where the employer can continue to provide additional contributions to that participant if they so choose. But for today's purposes, we're just going to kind of focus in on that participant contribution that comes in via payroll deduction. We're going to talk about the couple or a few options that are available to you as the contribution types to put into the plan. Again, it can be 1%. If you're doing that 1% into UMPIP, you're going to get that additional 1% CRSP-DC match. But if you can do more, we highly encourage you to do more. It's a defined contribution plan because the annual limits are set by the IRS. Now, one little sidebar note here, and it's just kind of a recommendation that I've always given, and certainly when we talk about Compass, it'll have a little bit of relevance there as well. When people are electing the amount of contribution that they want to provide per payroll period by payroll deduction into the UMPIP plan, you have the option to do a dollar amount, say $300 a month, or a percentage, let's say 3% a month. We always recommend do the percentage, because with a dollar amount, if you get an increase in compensation and you want the equivalent increase to be in that dollar amount, you have to remember to go in and make that change. And quite often that actually doesn't happen. But if you do 3% and you get an increase in your compensation, well, the 3% is going against the higher compensation, so you're going to get a higher amount on a dollar basis that's going to go into the plan. So, you know, a little personal thinking on that score, but we just think it's easier to do the percentage basis over the long haul. Again, your investment options, life stage investment management or self-managing. Again, defined contribution, the IRS defines for us through law and regulation the amount of contributions we can provide on an annual basis. Here is the combined amount before tax and Roth. It's not like each one has its own limit. These two here would be combined depending upon how you're utilizing them. If you're under age 50, the amount is $23,000 is the most that you can contribute in a year. For those 50 or more, you have the catch-up contribution of $7,500, which gets us to $30,500. And then there's also consideration as to how much is the employer given in 2024. And in aggregate, the sum of the two cannot exceed $69,000. That's both employer and participant. And we grant you that these are robust numbers. There is an environment where it may work, but these are robust numbers for individuals to be making, you know, those contributions on an annual basis. We're expecting the 2025 contribution limits really at any point in time. The two most common types of contributions is the before tax contribution and the Roth contribution. We'll touch on the after tax contribution coming out of this segment. But we'll look at the before tax contribution. Basically, the words are helping us here understand what's going on. It's before tax. You have your gross pay, and then that calculated amount, either the dollar amount or the percentage provided, we'll take that and we will put that into UMPIP, and then the remaining gets taxed, SECA, federal, state, whatever the case may be. The contribution is tax deferred. The earnings on that contribution is tax deferred, and it stays tax deferred until you start to receive income from that in retirement. And then that income coming out your way is exposed to ordinary income taxes. So 20%, 22%, whatever the tax brackets are going to be, that marginal tax rate, it would be ordinary income that would go into your taxes. But remember, we're going to talk about housing allowance tax exclusion, but that is how the before tax works. The Roth is actually an after-tax contribution, but it's an interesting approach to how we work with the Roth account. So you have your gross monthly pay. We know the dollar amount or percentage that we translate to a dollar amount that we want to put into the Roth account in UMPIP, but we don't deduct it yet. We take SECA, or you and your taxes, but you take SECA, you take any other federal, state, any other taxes that have to come out. Then we're taking out the amount of the Roth contribution, putting it into the plan, and the net amount is what you take home as take-home pay. So it's an after-tax contribution. So those dollar amounts, that contribution can never be taxed again. But because all the taxes have come through, we have in effect front-loaded the taxes on that amount into the IRS, into Treasury now. And if we qualify the Roth account in retirement, those distributions can come out to you tax-free. The contribution can never be taxed again, but because of the way we've structured this and taxes have been provided now, the earnings on that comes out tax-free. Now, it's a retirement account, so it's easy to qualify the Roth account. The first is you have to be over age 59 and a half. It's a magic number in the retirement world. But again, we're looking at the retirement years, right? Not full employment years. And second, the very first Roth contribution has to age up 5 years. If you do that first contribution, it's aged up 5 years. You're over age 59 and a half, you can get distributions out tax-free. And it's not every contribution or every year's contribution on a rolling basis. It's just at the anniversary of that very, very first one that you make. It's 5 years old or older. Over age 59 and a half, comes out tax-free. Now, it'll also qualify long-term disability, death of the participant, those types of life events. But in a general basis, you now have an amount that you can take out tax-free. Now, those who are kind of later in ministry, those that we talk to pre-retirement and retirement and all of that, we don't see a lot of Roth activity. But mid-career and young career clergy are now actually starting to look at the Roth a little closer and say, if I'm making sure that all of my employer accounts and benefits and plans are doing what they're supposed to be doing, and I'm covering housing allowance, then maybe later on in my career, maybe the last 8-10 years of my career, I can switch from before tax to Roth, create a bucket of Roth, so that when I go into retirement, I'm getting some out that is ordinary income with the housing allowance exclusion, and some that's coming out that's not going to be taxed at all. So it's a very interesting environment to me that we find ourselves in a church plan with a Roth account. As I said earlier, we do accept rollovers into the UMPIP from other qualified retirement plans. So a 401k, a 403b, a governmental 457 plan, traditional IRA, not a Roth IRA, traditional IRA. Those money can roll into the UMPIP, consolidate your retirement accounts into that one plan, and then all the options and flexibility to determine how, when, and how much income you want to derive is there. I don't see it as putting all your eggs in one basket. If people have accounts elsewhere, you may not be looking at it all that closely because you're kind of living in the here and the now. The prior employer has no responsibility to make sure that that money is being adjusted over time to prepare it for retirement income. It can just sit there static. So we, recommend, and granted, we are an investment house in some ways, so we like to run money, but we really do recommend that you roll that money in so you have control over it and you can determine how you want that account, those accounts to work for you in retirement. We have an incoming rollover form that was on that email that I sent to you. You complete that form, identify the current holder or custodian of that retirement account. Cheryl Hatcher, a fellow BE on our team. She also calls herself the rollover queen. She actually has a tiara and everything that she puts on when she talks about it. It's kind of funny. And she works behind the scenes and makes sure that that comes through as a direct rollover. Doesn't come through you. It goes directly into UMPIP. It's a non-taxable event to you. You will get a 1099 form. And on that form, it's going to say this was a rollover. It's not taxable, but that still gets generated. So don't panic if you do it. But it's all not taxable. It's now sitting, either you're self-managing it or in life stage investment management at that time in UMPIP. And that last bullet there, I say this all throughout my sessions. Contact your financial advisor, EY, your tax preparer or CPA to understand before you execute anything like this exactly what's happening, so there's no mishaps along the way. But again, we have the processes in place to mitigate any of that issue. When I first started in the 401k world, the amounts that you could contribute on an annual basis were much more modest, and we talked about these big numbers earlier. And a lot of people would use the after-tax because they could exceed the amount of the annual limit. Well, the annual limits have increased. But for those who have an opportunity, and there are many, those who have an opportunity in your household to maximize the amount that you're putting into the plan by virtue of that year's contribution limits, but when you do the math, you even have some leftover space, some dollars that you could actually put to work for you, you can put that into the UMPIP plan as a pure after-tax contribution. So you can switch out during the course of the year before tax or after tax, or just do the calculation in January to figure out how much is going to before tax, how much is going to go to after tax to maximize that out. Here with this after tax contribution, it is a pure after tax. The contribution dollars themselves will not get taxed again. They've already been taxed, but the earnings coming out on this account will be taxed as ordinary income. And the way it gets structured is kind of pro rata. Some of the distribution will be the non-taxable contribution, and then some of it will be the taxable earnings. So that's how that comes out. But that's available to people, again, as you have the opportunity and it may arise. So those are the current plans, the legacy plans, and now we'll spend a few minutes talking about the upcoming new plan, Compass. And Compass is a word. It's not an acronym. So that in and of itself is somewhat of a win, as far as we can tell. It's effective 1/1/2026. The overview on this is the CRSP credited service earned through the end of 2025. You keep that. The CRSP defined benefit, annuity benefit, is a protected benefit. You will, if you are eligible and all of the things have fallen into place, you will receive that annuity in retirement. What's going to happen is we're going to stop counting months and years of service as of 12/31/2025. So if you think about our annuity model at CRSP, as of 6/30 or 7/1/2025, it was 11.5 years. So as of 12/31/25, it's going to be 12 years. So full-time appointed clergy, 7 years will be frozen for 2007 to 13. 12 years will be frozen for that post-2013 to 12/31/2025. The retirement factors I reviewed remain the same. The first time frame, 1.25%, the second time frame, 1%. But the denominational average compensation is not going to freeze at the 2025 number. It is going to go up 2% each year ad infinitum throughout time, so that we know that we're continuing to lift and increase that benefit over time for future retirees. This was done in a way to mitigate the fact that on a global scale or on a national scale, we have contraction in mainline religions generally. We've had some items and issues within the United Methodist Church with disaffiliation. We did not want to find ourselves in a situation where down the road, the DAC started to roll over and go back down. So we have this now in place for it to go out at that 2%. So if you retire in 2029, well, you're going to have 7 years in the first time period, 12 years in the second time period, 1.25%, 1%, whatever that calculated DAC is as of 2029. So that's how that is going to work. What you have accrued, you keep. And it's a protected benefit under the law. We actually can't take that away, even if we try to figure out a mathematical way to do so. Again, active clergy will keep these benefits, and they will be provided later on. For retired clergy right now, there is no impact. Receiving their benefits, or even if they deferred for whatever reason for a couple of years, there's no impact on those benefits. Those benefits will be provided as is going forward. As far as the contribution environment is concerned, it's going to be 3 channels of contributions that will be provided. The first is a flat dollar amount contribution that will be provided to all full-time clergy in the denomination. That's going to be $150 per month. So going into 1/1/2026, the 2026, $150 per month. But each year, the amount is going to be increased by 2%. And when that calculation crosses over a $5 threshold, the amount of the monthly contribution is going to go up $5. So without really doing the math, I'm going to say it anyway, that in 2026, it'll be $150. 2027, it's going to be $150. 2027 will be $155. I think the calculated amount is like $156.50, but we're always going to do that calculation in an increment on a $5 level going forward. The second channel of contributions is going to re-individualize itself back to you. Your plan compensation is going to be 3% of compensation is an employer contribution that's going into your account. And plan compensation is going to include the percentage of parsonage allowance, as well as any housing allowance that you have. And in looking at the parsonage and then calculating the parsonage allowance, General Conference of 2024, we passed a proposal that says, let's elevate that percentage from 25% that gets included in plan compensation to 35% that gets included in plan compensation. And then again, if there's any residual housing, that will all come together as compensation. 3% of that will be a contribution. And then the third channel is a dollar-for-dollar matching contribution as to what you are putting into the UMPIP. And that matching contribution, instead of being 1% to 1% like CRSPDC, it's going to be up to 4%. So if you're contributing 4%, you're going to get a 4% match. If you're contributing more, and again, I'll always say, if you can do more, it's going to be a 4% match. But if you're only contributing 2%, you're going to get a 2% match. And in effect, 4% is being left behind. The additional 2% that you would be contributing and the additional 2% match. Now, we recognize that everybody's household situation is different. You know, I've gone up and down on what I'm able to put into a retirement plan over the course of my lifetime, my career. But just to point out that matching is really going to stay true to that 4%. If you're not doing 4% currently, again, it's not starting 1/1/25. It's starting 1/1/26. Maybe you can do some planning, some budgeting, that kind of thing to get you to that 4%. It's not really in scope for today's conversation, but there is also some consideration to students coming out of seminary and having student debt, student loans, and how that'll play into the contribution they put in and the matching contribution provided. But more information will come on that. And actually, more information will come out on Compass in general. I should have said this in the opening slide. We're still kind of going through the communication and education materials and all that, try to get that ramped up as we get to the end of this year and into next. But certainly by next year, we at Wespath, we love to provide emails and information and all of that. You'll be hearing plenty about Compass. As far as the spending phase for the employer contributions that are put into Compass, these accounts will go through life stage retirement income and provide income for you through that LSRI program. We're going to go through the LSRI program shortly. You have a core amount that will be provided to you. You have some other options, some customization you can do. We're going to review a thing called a Social Security bridge and a contract called a optional longevity income protection annuity contract that you can purchase going into retirement that pays out later on. Again, so the clergy contributions will go through life stage retirement income. Remaining balances will go to your named designated beneficiaries. You and your spouse both pass. Well, we've talked about retirement plans, the current, the legacy, and the future. And we do have the CRSP DB annuity, not in the investment markets, but Pretty much everything else is in the Wespath funds. Some of it by definition going to be in life stage investment management. Others you can self-manage, but still within the Wespath family of funds. So we're going to spend some time going through those. Not great detail, but we will spend some time going through that. So we believe there are several benefits of investing with Wespath. One is, according to modern investment theory, we do have a diversified set of investment options for you. We're going to review everything from a very conservative, low risk, low potential rate of return investment to income funds, some equity funds, to international equity fund, which is a high risk, high potential rate of return type fund. And when you have a spectrum like that, you want to get invested and you want to have allocated across that spectrum for better performance than just sitting in one area of one particular market. We have competitive returns. We do compare our funds to like funds, peers in the marketplace. They operate a lot like mutual funds, except they're not in retail. You can't just go and get our Wespath funds. They're privately managed funds, but they get priced on a daily basis. They get manufactured by virtue of the fund, the areas of the market we want to be in for that particular fund. Now that we do all of that, we want to make sure that the fund managers that we have hired, our people internally, are benchmarking themselves so that our funds are performing more or less as is the market at any particular point in time. You always want to kind of beat the market, as they say, but you also want to make sure that if you have an equity fund, and it's a U.S. equity fund, that you're looking at other U.S. equity funds just to see that that relationship is, correlating together. There are no commissions provided to anyone. If anybody came across a Methodist retirement home in West Virginia and brought them into the UMPIP plan, they don't get a commission for that. They don't get an ongoing run rate of payments throughout the course of time because that relationship, like in other investment houses, we don't do any of that. And because of that and the other things that we have going on behind the scenes, the money stays where it belongs, which is within the investment fund that we have. And because of that, we can have lower expense ratios because we don't have all these additional expenses. We're not paying out shareholders, stakeholders, commissions, those types of things. So we can kind of suppress the expense ratios that we have. The question was raised, how can we see what the expense ratios are? Go to wespath.org. There's going to be a tab to see the investments. Come down, click on the funds. Then you get a table. I think the first fund that just shows up, I don't really know why, is the multiple asset fund. But once you get to the funds, you click on the link for that fund. There's an information table on the right-hand side. In the middle of that is the expense ratio for that particular fund. So that's how you can find that. We're going to talk about life stage investment management, where we're tailoring the investment allocation for participants. We always say if you're going to self-manage or if you're going to use life stage, always take advantage of EY or your own advisor and understand what's happening. And then those last two bullets really kind of gets into who we are as an organization. Sustainable investing. Sustainability to us kind of means two different things. One is sustainability over the long haul. Like we've been around for 118 years or so. We're doing it now. We have every intention of doing it into the future. The changes that were made, the introduction of Compass is all about maintaining that sustainability for the denomination over time. But also it means how do we invest? Sustainable investing, ESG, environmental, social governance types of investing, screens that we have. We won't invest in certain industries like armaments and alcohol, pornography, that kind of thing. We don't get involved in that. So we have all of that kind of built in. Certain countries, we won't touch their investments or their sovereign bonds, that kind of thing. So we have all that's kind of baked in there. So sustainability is to have it, hold up for the long haul, but also uphold the values of the church. To go through the funds, we have these bullets or these buttons right up on top, the colored buttons. We have the short-term income fund. Our short-term income fund is the stable value fund. It's a capital preservation fund. It has a very, very low rate of return. It's manufactured that way and made that way. So it's got a low interest rate, low potential rate of return. But the idea is for that capital preservation. So as people are kind of into the retirement world or using the Social Security bridge, we'll use the stable value fund because we want that capital preservation. But over the course of the long haul for investment, you may not see so much of your accounts in the stable value fund unless you so choose and self-manage to do so. Then we have three income funds. These income funds are debt instruments, U.S. Treasury bonds, other sovereign bonds, companies who float debt, right? They're going to pay back that debt to the purchase of that debt through, coupon payments and percentage, interest rate percentage, all of that come in. We have a variety of those. The first is the Inflation Protection Fund. Here we're actually getting what's called Treasury Inflation Protection Securities, TIPS, that we're purchasing in that. This fund is really designed to help keep pace with purchasing power. It's intended to keep pace with domestic inflation. So it's a fund that helps us do that. The second is the Fixed Income Fund. This is a large fund. It's a broad array of these different types of debt instruments, cash alternatives, other types of things that can come into this fund. So our treasuries of different length and duration, other sovereign countries and their bonds of different length and duration, U.S. corporations, foreign corporations, and their debt floatage, we put that into this fund. Because you have all this variety, you have a higher rate of risk. But with a higher rate of risk, you have a higher rate of potential return. And then the last is the Extended Term Fixed Income Fund, which is looking at the longer dated bonds, those 10 years, those 30 years that are out there. No one knows what the economy is going to look like next month, more or less in 10, 15, 20 years out. So there's an additional premium or premium risk that gets put on to funds that manufacture themselves purchasing those securities. So because of that, there is a higher level of risk with a higher level of potential return. But still, these are fixed income funds that generate income on a monthly basis by virtue of the holdings that we have in those funds. Then we have our multiple asset fund and our equity funds. I'm going to bring you down there first. Our equity funds, we now have three. Several months ago, we introduced the U.S. Equity Index Fund. It is a fund that's designed to track along with an index. It's the Russell 3000, so it's kind of like an embedded benchmark into the fund to see that across a broad swath of the companies that we have in the country that we are tracking along with this Russell 3000. Then we have the U.S. Equity Fund, and this is an array of all kinds of U.S.-based companies. You're talking about company stock. So just by virtue of talking about company stock, we've elevated the level of risk because company stocks have more risk than do fixed income funds. U.S. Equity Fund, we're not just looking at one sector of the market. We build this fund looking at the large growth company, the large companies, the large capitalization companies, the big companies that we see in TV all the time, right? The Apples and Googles and all of that of the world. But then also mid-sized companies, small-sized companies we may not be hearing about, but they're traded in the public marketplaces. And then there's growth funds, those that keep cooking, that we see in the media still, keep cooking the market going forward, but also what they call value funds, where the professionals behind the scenes see ABC company and say, we think this is undervalued, we think it's going to raise in its value, we're going to buy it, and then if it does, and they're right, it raises in value, we get the gain in the fund from that. The International Equity Fund is the same kind of principle, is that it's foreign companies that we're bringing into the fund, so Siemens and Sony and those types of companies that are in this particular fund. But large capitalization, big companies, mid-sized companies, small-sized companies, growth, those that are expected to maintain a growth orientation, and then also values, those companies where the professionals are saying we think they're undervalued, we're going to bring them in to get the raise or the increase in the funds once those companies normalize to what they think their market value is. But it's international. So you have emerging markets. There's a lot of risk in emerging markets. You have currency risk, what's happening in the currency markets across the world. And of course, there is some geopolitical risk, that we know that exists as well. So this is the highest risk fund, but with the highest rate of potential return. And I have a slide on that as well. With the multiple asset fund, what this is a fund of funds. It's a balanced fund where we are intentionally building that diversification into one fund. So we're taking two of our funds that are equity funds, and we want to be about 65%, 35%, 30% with that. And then we have the fixed income side, the more conservative side, at 25% and 10%. And we run this fund that way on a regular basis. So there's always some refinement, adjustments, and trading that has to go on to keep it in that general range of 65% and 35%. And again, you're getting that diversification across the markets, the asset classes in that one fund. And if you're comfortable doing that, do that. I would definitely speak to an EY or a financial advisor if you wanted to use this fund and other funds, just to see what the interplay of that would be. And then you're self-managing when you're in this fund, just to let you know that. We talk about life stage investment management, which is right around the corner. You're going to see that's different in terms of how we deal with percentages on equity and income over the long haul compared to this fund, which kind of is static as it goes forward. As I said, we also have the philosophy of ESG and screening and making sure that we truly are living into that. And through that, we actually have 3 funds which have a heightened focus on a company's environmental, social, and governance performances. Here we have 2 fixed income funds, another inflation protection fund, and a broader choice bond fund that has an array of different types of these instruments in them, bonds and corporate bonds and all of that. And then we have the social values choice equity fund, which is a broad array of equities yet again, but again, carved down a little bit more with a heightened focus on companies and countries' environmental and social performance. You can access these funds if you self-manage these funds. If you self-manage your account, these funds are not, at the moment, these funds are not in life stage investment management. Well, I do think there is some research going on. It will probably take a couple of years to get concluded, but that this may actually be something down the road that becomes available. Not making any promises. Here's that risk and potential return element that I was talking about. You can see in the lower left-hand corner, we have the stable value fund, low potential, low risk, very, very low risk with a low potential rate of return. We saw it going up a little bit to the right. You can see even though we're in fixed income, where we're getting income just by virtue of the instruments or the assets and securities that are in these funds, but still, there's some risk as we go up the scale. Extended term fixed income, that end of that longer range of bonds, higher rate of risk, higher rate of potential return. Multiple asset funds got the blend. Now we're into the equities, international equity, highest risk, but the highest potential rate of return. So when things are going smoothly and emerging markets are really starting to expand, you can start to see some of that real return. But as we know, at any point in time, something can happen, and this goes all topsy-turvy, right? This is a historical representation of risk and potential return across these asset classes. The pandemic came in, inflation came in a couple of years later, things got all topsy-turvy. But history tells us that over time, this is the way these types of investments will perform. Past history is not a guarantee of future performance, but still, this is a historical view of these types of funds and asset classes. With these funds, again, you can self-manage if you're comfortable doing that. Right now, I'm self-managing. I do plan on within the next 6 to 12 months, just kind of waiting on a few things to play out. And then I'll probably go to life stage investment management. But if you self-manage, that's great. Just keep your eye on things. You don't have to panic and do things each and every day. Periodically take a look. Life stage, again, with the program I'm going to review with you where we're tailoring it. But you also want to get an understanding of really how this program works for you to make sure you're getting the most out of it. So which is why right there at the very bottom, again, we do another shout out to EY Financial Planning Services. They know our funds, they know our plans, they know our programs. You can call them and review all of that with them, even if you're self-managing or you're actively involved if you're actually involved in life stage investment management, then you can do that as well. So use EY as it becomes advantageous to you. Life stage investment management. We're finally here to talk about life stage investment management. It's a personalized investment management tool for your defined contribution accounts. Now, life stage investment management, all of your NPP accounts are in life stage investment management. You have the choice for your other accounts, your CRISP BC, your UMPIC, PIP. If you do rollover into that, you can determine that. We set an allocation up and we look at it in 2 different time frames, okay? The first thing we do is we look at an individual and we say, okay, what age are they at? Are they married? When do they think they're going to retire? Or when do we think they're going to retire? Assumptions around Social Security. And we look at them and we say, let's say, okay, we have a 55-year-old individual. And we set them up and they have a moderate risk tolerance. We set them up in an investment allocation at age 55 of, let's say, 70% equity and 30% fixed income. So those funds I reviewed equity, the funds I reviewed fixed income. As we age up, the amount of the equity exposure slowly and subtly comes down. The amount of the fixed income exposure slowly and subtly comes up. Now we're getting you into and through retirement, through life stage investment management, with that continuing glide path to make sure that we have equity at any point in time to generate that growth, that better rate of return. But we have to continue to build up the fixed income side, because now we're making payments in retirement, and we have to make sure that we have the account in place to make those payments at that time. And at that time, you may see more of your account in that stable value fund, just to continue to build that foundation in retirement for that income. So that glide path happens over time. But we're also looking at it at a quarterly basis based upon your birthday. So we look at your birthday, and quarterly off of your birthday, we look and we say, hey, you're 55 years old. We want you at 70-30. Market's gone gangbusters. You're now at 80-20. Well, that sounds good, but that's not what we want you. So we're going to start to make the adjustments and rebalance the account to get it back down to 70-30. Or the market's went the other way. It's now 60-40. Still it might be okay relative to returns, but that's not what we're looking for. We want to get you back to 70-30. So we're going to do the rebalancing to get you back to 70-30. And because we're doing both things, that long-term glide path, but we're looking and doing active management of your account in the real time, I'm allowed to say that there's a potentially higher internal rate of return from that portfolio in life stage investment management, because we are looking at it and making modifications over the short term as to where we want you to be, and over the long term to get you set up for your retirement income later on. The combination of those two things makes this a very, very powerful program. So again, we're managing the investments during your active service and retirement. If you go into life stage retirement income, and you'll hear this again, you're in life stage investment management. But no matter how you're taking your monthly installments, even if you're self-managing your monthly installments, you can be in life stage investment management just to keep that allocation working the way you want it to work. We do the diversification of the investment portfolio. So again, we have that glide path, but we're keeping equities, we're keeping fixed income. And this is different than that multiple asset fund that I reviewed where it's 65-35. That kind of stays static. And again, it's not no value judgment on that. That just stays where that is though, 65-35. Whereas here, at a point in time, you could be 65-35, but as we're aging up, we're getting that a little bit more set for that future use in retirement. We're looking at your age, your benefits commencement date. If you have not given to us what you think your benefit commencement date is going to be, we'll default to 65, the normal retirement age. We assume Social Security benefits unless you tell us otherwise. And then risk tolerance. And this is one where you really can kind of more or less kind of get a little bit more or less out of the investment portfolio depending upon where you are from risk tolerance. You could be a conservative investor. That's what really helps you sleep at night. You can be a moderate investor, middle of the road, let the market activity kind of come and go as it pleases for the time period, and you're good with that. Or you're aggressive. Maybe it's because you have a time period to be aggressive. I'll probably go in aggressive and then start to pare down as they get closer to my retirement age. But you can be aggressive. It's probably like a 5 percentage point swing in the allocation relative to equities and fixed income as you do that. But you can control that. What happens is, if you come into the plan and you are actively engaged and there is a life stage investment management form or profile in that email that I sent to you, you can make determinations as to how you want life stage investment management to be set up. You can give us a different commencement age, maybe you opted out of Social Security, your risk tolerance, etc. But a huge amount, maybe a majority, but a huge amount of our participants actually default into life stage investment management. Contributions start coming in, haven't really set up an investment allocation. We're not just going to leave it out in like stable value fund, not doing anything. We will set up a life stage investment management default profile for you. We're going to have you at a moderate risk tolerance. 65 is the benefit commencement date. Again, normal retirement age, and assume eligibility for Social Security. Many people, when we're in the room in seminars, I'd say about half the room doesn't really know if they're in life stage investment management or self-managing kind of thing. So which means they defaulted into life stage investment management. And there's no harm, no foul in that. But if you're not sure, and even those who are, it's a good idea periodically, benefit access, to take a look at your allocation to understand how it is working and how your profile is set up. If in that engagement that you have, let's say within the next week, 2 weeks, or whatever, as a result of this webinar, you go and look at the profile and you make a change to it. You go from a moderate risk tolerance to an aggressive risk tolerance, for example. So I want to point out that it's not going to be effective right away, like the next night into the next day. You make that change on benefit access, and then on that quarterly anniversary of looking at your account, that's when we're going to come in and we're going to see you made those changes, pull those changes, apply those changes, and you'll see those changes on your subsequent statements. And for those who are looking at participant statements, maybe not quarterly, maybe you just look at your December 31st statement going into a new year. You look at page 4 and you see all of these transfers going on. What's happening is LifeStage Investment Management is continuing to do its thing behind the scenes. So again, great program. And again, that's the rebalancing that we talked about. We got the glide path, we do some rebalancing, and then we look at you quarterly and rebalance as necessary. As far as resources are concerned, we'll talk resources again, but we have a plethora of resources at Wespath for you as it relates to the investment information. You have your daily values. Again, these are like mutual funds. They value every day, net asset value. You can get fund descriptions, high level, they go deep. You can see the benchmarking. You can see our operational expenses or fees and those types of things. You can look at the investment funds in greater detail on wespath.org or benefitaccess.org, but this is actually open to even the public realm, the World Wide Web. The distribution choices that you will have in retirement, and this is really getting into your account balances. Your CRSP defined benefit, that's the annuity. You have taken the annuity for NPP, or you didn't take the annuity for NPP, but you're taking that 65% life stage retirement income. Okay, that's there as well. Your UMPIP, if you have rollovers in there, the UMPIP in its entirety. The CRISP DC that rolled into UMPIP, that 35% of NPP that rolled into UMPIP. Now in UMPIP, you have a lot of flexibility, a lot of options, a lot of choice as to how, when, and how much income you want to derive from those account balances. You can take cash installments in one of two ways. You can use life stage retirement income, which is the next segment that we're going to get into, where we're tailoring the investment allocation for you or calculating the life stage retirement income, where we're determining the amount of monthly income to provide to you. Or you can self-manage it, say, I don't want to take anything right now, I'm going to defer it, or I want to get $1,000 a month, or maybe you just come in once a year and take out a couple of $1,000s around Christmas to handle Christmas gifts and all of that. You have that option available to you. You can take a full lump sum. This is your account balance. You can take a full lump sum out of the UMPIP, but just some words of caution. First is, if you take it out, it's not in the plan to provide retirement income through retirement for you with the housing allowance tax exclusion that you enjoy with your distributions from your accounts from Wespath. This is your account. You can roll over the account to another qualified retirement investment vehicle somewhere else if you so choose. But if it's not another church retirement plan, then chances are you are not going to get the housing allowance exclusion. Like, I can't say 100%, but I'm comfortable at 99% that if you roll the money out somewhere else, you will not be able to declare, they who receive that money will not be able to declare that income is eligible for the housing allowance tax exclusion. So there's great investment houses out there with great investment vehicles, Fidelity, T. Rowe Price, Vanguard, but they can't declare the income that's going to get kicked off from their products as eligible for the housing allowance tax exclusion. Also, if you take a full lump sum, one last thought of caution, if you take a lump sum distribution, you've now really kind of given yourself a lot of income for that year, which will more than likely raise the overall tax bracket, the overall ordinary income marginal tax bracket that's going to apply. So you'll pay higher taxes on that, potentially as a result of that full lump sum distribution. Partial lump sum distribution, a lot of those words of caution also apply, but we understand and recognize and know that's why NPP 35% was created in the first place. that clergy persons going into retirement are looking to get some of their retirement accounts to help purchase a primary residence. So you have that partial lump sum that's available to you. But again, speak to your EY advisor, your personal advisor, your tax planner, CPA, to understand the timing of taking that and what the consequence of that's going to be in the year you take it, and then again into future years as well. It's not on this screen, but in ministry, in active ministry, in the UMPIP, there is a loan provision you may be aware of. If you're going to buy if you're purchasing a primary residence, it's a 15-year loan. For any other general purpose, it's a 5-year loan. You can take that loan out. You have that loan provision available to you in retirement, which is very, very rare because usually, plan loans come through a payroll deduction with the employer that you're at. But with us, the way we structured is we just get your banking information and we'll do a deduction from your bank account. I think the 15th of each month, we'll do a deduction from your bank account to pay off that loan. So in retirement, you also have that loan available. So going into retirement, you need $12,000 to do that big vacation or fix the roof on the house or what have you. You don't necessarily have to take a distribution with the taxes and all that. If you can figure out on a monthly and annual basis that the cash flow will be fine by repaying the loan back to yourself at a rate of interest, so you're getting some of that interest back into the account that you've missed because you took it out of the investment markets, that you'll be able to use that as retirement income later with the housing allowance tax exclusion. Anything remaining in your account balances goes to your named designated beneficiaries. And again, at some point in time, if you're not taking anything and you've deferred it, it's part of your overall estate planning, you want to pass this on to your heirs, the IRS will still say, you got to start taking some required minimum distributions. So life stage retirement income. This is actually an award-winning program that we have. It's for your DC plans, your DC plan accounts. Pension Investments Magazine actually did provide an award to us for the program that we came up with. There's an annual adjustment that's made to the amount of the life stage income that we're providing to you. The adjustment's going to be based on age, investment growth, and no loss, etc. I'm going to get into that. If you're in life stage retirement income, by definition, you're using life stage investment management. They work in tandem. And the goal is to provide monthly income payments for you. What we're recognizing is that some people go into retirement and no fault of their own, maybe taking too much out than they should be on an annual basis, and then it starts to strain later on. Or other people can take out more than they are, like they're kind of being conservative about it. And hey, you can get a little bit more enjoyment out of your retirement. You have the ability to take out more. So this kind of program kind of helps you kind of figure out that amount, that sweet spot that is good for you to take out distributions in retirement. And we'll talk about some other options available as well. On benefit access for anybody who's eligible to retire. So if you hit that age 62 or 30 years, as well as 65, 40, but you're not necessarily retiring, you can still start modeling and playing around with what life stage retirement income is going to look like for you. You do not have to put all of your personal accounts into life stage retirement income. You can carve out some, say maybe 80% of the account balances into life stage. The other 20% is a reserve fund, a fund, emergency fund, however you decide to do that. And I think that's, here that you can add more funds to the account. If you don't have time to roll over before you go into retirement, but you're now in retirement, now you have access to employer accounts that you want to roll over, you can do that. Add that in. Again, you have flexibility. You can go for your personal accounts. You can go into life stage retirement income. You don't like it. You want to self-manage your installments. You can do that. But you're self-managing your installments for a while. You don't want to do that anymore. You're going to go to life stage retirement income and let the program work for you. The operating expenses that we talked about in the context of the investment funds, it kicks off this operating expense, these fees. It pays for the overhead for Wespath, salaries, pens, pencils, the whole thing, but also our program. So there's no direct out-of-pocket cost for you to use life stage retirement income, to use life stage investment management, to use EY financial planning services. There's no fees associated with that. With life stage retirement income, the way the algorithm works is the first thing that we do to develop the base amount, what we call the payment safety zone of retirement income you're going to receive, is we apply the principles of an annuity. We apply the principles of actuarial mathematics and mortality tables and all that complicated stuff behind the scenes. And we run market models. We run market models, thousands of market models. So what do really, really strong markets look like over the long haul? What do really, really weak markets look like over the long haul? And we have these goalposts or guardrails, and we kick a field goal and we say, going into retirement, we feel from these account balances, we can give you this amount on a monthly basis. And then in November of each year, we recalculate the amount with the intention and the practice of giving you increases in that amount over time to help you keep pace with purchasing power. So again, we're applying the principles of an annuity and long-term thinking around life expectancy and all of that. We're doing it in such a way that we don't have a hard COLA percentage baked into it, but we know through market performance over time that we're going to generate more asset value from your accounts just through that market performance to give that as increases incrementally over time to help with purchasing power. Now you're in life stage investment management. We do the recalculation and we can have a down year in the market. If it's not a particularly bad year, it's kind of a down year, but not a bad year. Well, you may not see a decrease in the amount year over year because we have the goalposts, the guardrails, and we have some latitude in there that we could keep the amount the same 1 year into the next. If we have a particularly bad year in the market at the time we do the recalculation, you could see a decrease from 1 year over the next. But history tells us that markets do normalize and come back into an upward trend. So you may see that, but then over time, we'll be able to get back to, again, this is what history is telling us, get back to providing that increase over time to help you through retirement. And it's about that sustainability concept, right? We're doing it in such a way that we want that sustainability to happen through the long haul of those account balances, providing income to you and your spouse through retirement. But we have two additional features. They're customizable and they're optional for you to use. The first is a Social Security bridge. So here, what we're doing is we're saying, okay, you have your account balances, you're in life stage retirement income, we've come up with this payment safety zone amount, that initial base amount that we're going to provide to you. But if you recall from earlier when we talked about SSA.gov and Social Security, the way Social Security works is we each have a full retirement age. So for me, it's age 67. For each year that I defer receiving my Social Security until I attain age 70, I get an 8% increase in that amount of Social Security benefit. So that's 24% over the course of those 3 years. There's no further increase after age 70. So at age 70, you kind of come out and take your benefit. But at age 70. So let's say I want to do that, but I need some income to help me on a monthly and annual basis just to maintain everything. So what I'll do is through Life Stage Retirement Income's input screens, I'll say, give me this amount as if it was Social Security. So let's say $1,800 a month. And from your account balances, we'll give you that additional $1,800 a month. In my example, $1,800 a month until such a time that you attain age 70. Well, we're just going to stop doing it. Or you don't have to wait to age 70. You can start at any time after that. And then you let us know that, and we'll stop giving you that $1,800. By doing that, we're leveling off the amount that's coming out of your account balances. We're no longer paying that additional amount, the as if Social Security amount. And that helps us maintain that sustainability of providing income to you through the course of retirement through that payment safety zone amount of life stage retirement income. That is an option that's available to you. You do not have to use it. And again, if you decide you want to go into retirement and take advantage of that, you don't have to wait till age 70. It's not really working out the way you thought it would. You can always just go ahead and start receiving your Social Security benefit. And then the second option is this longevity income protection. It's actually a deferred fixed annuity. It's a life and 70% survivorship annuity or a single life annuity that you purchase going into retirement. So through the benefit access election screens, we'll help determine an amount available to you to purchase this annuity. And then it begins to pay when you attain age 80. So you're going into retirement, you have purchased this contract, it's actually with Pacific Life, and you're using your account balances and all of that, and then you have your CRSP annuity, your MPP income, your Social Securities, your spouse, all of that. And then at age 80, another layer of guaranteed income that you, and if married, you and your spouse cannot outlive, that will last throughout your retirement. And here again, we're going to level down the amount that's coming out of your account balances to maintain that sustainability over the long haul. So here you may see a reduction in that payment safety zone amount, but it's equivalent to what you're getting out of the annuity. So that's out to be the same, and we're continuing to have that get paid to you over the long haul. Again, this is part of that peace of mind, kind of following that, Goldilocks kind of not spending too much, spending too little, and really planning for the near term and the longer term of retirement income. The fees on this is very low because we're considered a group insurance rate. We get a group insurance rate because of the organization that we are, the denomination that we are. So that helps along the way in terms of the amount that's going to get applied to the annuity. So that's a good thing. And then again, it begins to pay at age 80. So if you, the clergy person, decide to do this and you pass away before your spouse would be receiving the benefit when you will have attained age 80. Okay, so if you're like in your mid-70s, something tragic happens, then when you would have hit 80 is when your spouse would be receiving that 70% annuity as a life and survivorship annuity. And these options available to you, you don't have to necessarily take them, but this is kind of how it works visually. Let's just say this first bar and bar graph over here on the left-hand side, retirement begins. This is a blend of the payment safety zone amount, that initial base amount that we calculate, and then that additional $1,800, if you will, that's that Social Security bridge. And then when you get in Social Security, we're leveling off what's coming out of the account balances. You have that Social Security on top, and it's a flat line, but remember, it's gone up over the period of time that you've deferred receiving that. So it's, a little bit more, and then you have your account balances. Then at age 80, the other contract kicks in. You're receiving that income, your Social Security, and all the other things that are stacked on top. Social Security for your spouse, your retirement benefits out of other Wespath plans, your spouse's plans, and all that. And then we're reducing the amount coming out of your account balances. And this would be a downward adjustment, but we're going to continue with that increasing principal over time to help with purchasing power through retirement. So that's how the program works. So it's good thinking that needs to get done relative to determining whether or not the program itself and elements of the program are right for you. Again, longevity and health issues always kind of come in to the financial planning. It's not the most comfortable part of it, but comes into the financial planning conversation. If you've opted out of Social Security or you're already taking Social Security, that Social Security bridge would not be available. If you're retiring like mid-70s, you may age out of the applicability of that longevity income protection contract. But again, that's if you're really going long in employment before you decide to take your retirement benefits. And then again, it's everything working together. How does it all tie together as a macro household financial plan relative to taking advantage of the program and the options that are available to you? And again, if you have other qualified assets that can roll into you on PIP, put them in there, and then you can see what the consequence with the impact of that additional dollars would be on the advantageous elements of the program. We've talked about required minimum distributions a few times. Again, age 73 or 75. Up until just a few years ago, and for a very long period of time, it was 70 and a half. Again, half. 70 and a half. Secure Act 1.0 changed it to 72, and then 2.0 changed it to 73 or 75, depending upon your year of birth. The next slide will tell us that. The way it works, the year in which you attain your required minimum distribution age, so age 73 in 2024. You don't have to take your RMD in that year if you so choose not to. Again, financial planning. You may decide not to. You want to defer receiving that first one into the following calendar year. You can do that during the course of the first quarter of that year, but you need to take it out by April 1st of that subsequent year. And just note that in that subsequent year, you're taking two RMDs, the one you deferred from 24 into 25, and then 25's RMD. And then you can work, again, planning the timing, how you want to receive that in that calendar year is also up to you at that point in time. What we do is we look at your market value in these accounts, these plans in these accounts as of 12/31 of a given year. We have the market value the IRS provides a table as to what the required minimum distribution is. It starts at like 3.2% of the account and slowly increments up. I don't think it's overly aggressive as far as that is concerned. But again, now it's telling, okay, now you need to get an R&D of X dollar amounts. But again, housing allowance tax exclusion, the R&D may not necessarily be taxed depending upon how you have everything laid out in that global retirement income plan that you have. It will apply to those plans that you have deferred. If you aren't taking anything from NPP or your UNPIP account balances or what have you, well, we're going to be in touch with you well in advance of you having to take that initial R&D because there's tax consequences if you do not. It's ordinary income. All R&D is going to be ordinary income coming out of your accounts. However, there is a 20% tax, could be 25% tax, escaping me at the moment, additional tax consequence on top of that. So if you're in a 20% tax bracket and it's a 20% penalty, well, 40% is going to be taxed. So you want to make sure you have that all working as well. But again, we'll be in contact with you well in advance. As far as it goes with the new rules under Secure 2.0, if your year of birth is 1950 or earlier, it's age 72. 51 through 58, it's age 73. Anybody born in 1959 or later, it's age 75. When you are making your distribution options, be them for your retirement income from your plans and account balances, on benefit access, or if we're processing RMDs for you, because that's just how it's going to work in your arrangement, you need to actively tell us how you want us to treat your federal tax withholding, even if it's zero. You have to tell us, direct us that it is a 0% that you're trying to accomplish. You're trying to accomplish. The federal government law tells us if we have no direction in full or partial distributions or in your RMDs, there's a tax amount that a percentage that has to be withheld as taxes. That's 20% or 10%. So you're going to see that on the election screens. Is going to be an area where it says, a whole screen. What do you want to do for tax withholding? And you can have a checkbox there that says, I don't want any federal tax withholding done. So we now have direction for you to be zero. So we're good with that. And some clergy will do that because of the housing allowance tax exclusion. They'll go in and kind of figure out housing allowance that way. So you have that option available too. But again, you have to tell us that directly. Initial benefits processing will kind of take a step back in a bigger picture view. You're going into retirement. It's your retirement year, be it 2025, for our example. So today, you have until 3 o'clock Central Time on June 30th, or if June 30th falls on a weekend, the last business day of June, 3 o'clock to make your elections to be effective July 1st and to begin to receive your payments. And of course, we say don't wait until June 30th. You might want to do it the end of May, early June to really have gone through webinars, seminars, EY, your own planner, your accountant, have everything in good working order, know what you want to get, know your options, set that up through benefit access. To let you know, if you set up something, a transaction request for your income on benefit access, it goes to a pending file. If you change your mind before we start processing it, you can always go into that pending file, hit cancel, the transaction will be canceled, and you can either defer it or recreate another one based on some difference that are happening. Maybe you're changing the COLA percent. Maybe you went with 2 and you did some more math and you want it to be 4, or vice versa. You did 4, you realize, I could use a higher income now. You go back to 2. Those types of things. But once we get into June 30th, July 1st, whatever we have, we're going to process. Now we're processing 6/30 into July 1st. Well, because it's July 1st and there's a tremendous amount of activity that's going on with our new retirees, there's a reconciliation process that takes a couple of days to get through to make sure everything processed good, clean, and is ready to go. And then we're going to send those initial payments to you. But oftentimes we bump up into the 4th of July holiday. So because of that, we could end up with an additional couple of days delay around getting that initial one into your accounts. So for next year, they're anticipating July 7th to be the day that the income will hit your accounts. Again, that changes year by year, depending upon where the 4th of July falls. But after that, from that point on, the first business day of the month, you're going to receive your annuity income, and the second day of the month, you're going to receive whatever installment payments you're getting from your cash account. So second or third. So, the hedge it could be the third, but from what I understand, it's pretty clean now that we're hitting the second of each month. You're getting your income on a monthly and an annual basis. and the housing allowance tax exclusion still applies to you. A lot of people, believe it or not, going into retirement, attending these things, aren't aware that the housing allowance applies in retirement. It's similar but different in retirement. You have your charge conference. You have to determine what's eligible for the housing allowance and what you can actually apply towards housing allowance. Here, that's the same, but I'm going to highlight a key difference momentarily. I'm going to review with you 3 different numbers that you have to generate and record. And it's the lowest of the 3 that you can use in any given calendar year as your housing allowance exclusion that comes right off the top of your overall household income for that year. The first is the amount designated in housing allowance. Well, this one's going to be actually rather easy because we're going to send you a tax form 1099-R that's going to tell you the amount of income you received from us. The determination of the amount that's eligible for the housing allowance in retirement is actually done on an annual basis. Your annual conference, in your annual journal, has a resolution that says in the next calendar year, all of the income that is received from Wespath, our retirees receiving their income from Wespath, that amount is eligible for the housing allowance tax exclusion. Again, eligible for the housing allowance tax exclusion. Always has to be declared in advance. So in the middle of one year, it's already looking at the next subsequent year. You don't have to do anything about it. It's done for you. So what we would recommend is the year you retire, whatever that resolution is in that year's annual conference journal, just rip it out or print it out, put it into your tax folder so you have reference to it. But it just happens on a rolling basis each and every year. But that's still the first amount. What's the amount that's eligible? The second is what's your actual housing expenses. You want to keep this as north as possible. So it includes the big ticket items, right? Your mortgage or interest if you own your place, your homeowner's insurance, or if you're renting, the amount that you're paying in rent, your renter's insurance, all of your utilities, phones, cell phones, and somebody did ask cell phones. Yes, cell phones would apply as well. All of that. Plus, if you go to Walmart, you buy Fantastic. It's household cleaning products. That applies. Snow removal, landscaping, all of that applies to the overall expense. And again, you want to keep that number as low as possible because it's the lowest or the least of the 3 that I'm reviewing. And then the last is if you own your primary residence, what is the fair rental value of that residence, fully furnished, plus utilities in the neighborhood that you live. So it's a market model where the IRS has you go and say, hey, what could you rent your place for, all inclusive, right? Here we recommend to get that fair market value, go to a realtor. Someone asked that. Go to a local realtor and get that. They can give you a comp letter, the comparison letter, comp letter, and there may be some range of numbers in there that can be legitimately be used as it applies to your own particular circumstance. We do hear some people will go to Zillow or like websites and get an amount, honing in on their zip code and property type. And if the accountant's comfortable with that, then that's all fair and good. But we're a little conservative. Go and start a relationship with a realtor if you don't have one. You can have one in your congregation for all we know. You just know one from the neighborhood. So that would be the recommendation we would make. Now you have 3 no's. What was eligible? What'd you get as retirement income from Wespath? What's your actual expenses? What's the fair rental value of your place? And it's the lowest or the least that comes right off the top of your household income. And the rest goes into your tax filing season with other exclusions, deductions, and credits that are available to you. So here's an easy example of that. I'm just going to go through this quickly. $24,000 of pension is provided to the clergy person, the retiree. Their actual housing expenses is $20,000. They could rent the place for $21,000. The housing allowance exclusion is the lowest or the least, so that's the $20,000. The amount taxable is $4,000, but that doesn't mean it's all going to be exposed to taxation because it's just going into the 1040 with all the other adjustments that get made, exclusions, deductions, and credits. So some of that may not be taxed as well. With the housing allowance exclusion, it's available to retired clergy. It's not applicable to the surviving spouse unless that is also a clergy person. It's for your primary residence only. If you own multiple properties, it only applies to your primary residence. In that email that I sent, or on that email that I sent, is a housing allowance exclusion worksheet. In the back of it, I think it's paragraph 4 towards the back, the end of that paragraph. In brackets, you'll see, or quotes, you'll see Couple of sentences that we recommend that your tax preparer just put onto that 1040, just in case someone's looking at it, doesn't understand it. They'll go, oh, housing allowance applies, and move on. And again, this is in your conference journal each and every year. Death and disability benefits for the Comprehensive Protection Plan. There's mandatory participation for eligible clergy. That would be serving full-time and a compensation of at least 25% of the DAC. And at a plan sponsor election, it could be 3/4 time and or leave of absence. Any questions around this, we would send you to your annual conference. Not eligible is clergy appointed, half-time or quarter-time. These are the different types of individuals and beneficiaries and life events that can happen that would provide a death benefit to participants. Their spouse or if a child passes away, it will go back to the participant or their surviving spouse. So that information is also provided to you on another document I provided that covers the Comprehensive Protection Plan. For the death benefit eligibility in retirement, you have to receive a benefit from CRSP at the time of retirement. That will change to Compass down the road. Enrolled in CPP for 12 of the last 15 years, or active participant in CPP for 25 years. So there's a recognition that we have long tenured clergy in ministry for a long time. They've been in the plans, the programs, all of this time. So they have 25 years, but there's also recognition of those who came in mid-career, late vocational ministry. And we want to recognize that if 12 to 15 years of that environment, they're in CPP, they also are eligible for the death benefit. General Conference of 2024, we harmonized the death benefits. It used to be one table of benefits if someone was in active ministry, and then another if a person was in retirement appointment. So we kind of brought them together and harmonized them. The $50,000 that you see there is for active participants. So you have an active participant, that person passes away, their spouse or named designated beneficiary will receive that amount. And that amount stays true through active participation in the plan. The other dollars that I'm going to go through on the right-hand side, those are not fixed dollars. Those will go up 3% per year each year as the amount of benefit. So instead of having to wait for the next general conference to make upward adjustments in the amount of benefits, we now have the resolution passed where each year, kind of like the DAC going up 2%, this will go up 3% as a benefit. So again, active participant passes away, the spouse or named designated beneficiary receives that amount. But where you have a retiree, the retired participant passes away, $24,000 will go to their spouse or beneficiary. So you have that $24,000. If in retirement, the spouse passes away, active or retirement, we harmonized, active or retirement, but the spouse passes away, $16,000 will be a benefit to the either active or retired participant. In a circumstance where the participant passed away, the spouse who became the surviving spouse gets a benefit, and then that surviving spouse passes away, a benefit will be provided to that surviving spouse's named designated beneficiary. And in the unfortunate event where an eligible child passes away, a benefit will be provided to either the participant or surviving spouse. And again, those dollar amounts there will increment over time. And as far as the eligibility of all this is concerned, more detail is provided to you on that worksheet that I provided in the email covering the Comprehensive Protection Plan. While in active ministry, we still have the long-term disability benefit. This long-term disability being defined as unable to perform duties due to injury or illness for at least 6 continuous months. So you're going to go into long-term disability. And this is the way the benefit will work. First and foremost, I do want to highlight that somebody going through this is going through a fairly difficult time in their life. But still, you have to do all the required paperwork. You have to get all the detailed information from your providers, primary care physician or mental health provider, whatever the case may be. We work with a firm called Lincoln Financial, right? They're like an insurance carrier. They do the adjudication of the cases for us. Good stewardship. We really need to have an outside party at that level of expertise and detail to do that, right? You just want to really kind of follow and make sure that you do all of that. Not the best timing for it, but still you want to do that. But then you go through that and you are eligible for long-term disability. The benefit you will receive is 70% of your planned compensation at the time that you go on long-term disability. And your planned compensation is your housing and or parsonage plus your cash salary. So that's what your plan compensation is going to be. You're going to get 70% of that. You're continuing to contribute in UMPIP, that will continue to go through, and your matching contributions will continue to go through, but other contributions will still be made either through the CRSP accrual of time, if it's in the here and the now, or in the Compass world, contributions going into the Compass plan. So we're still in that environment. The plan compensation that we are using to determine the amount of benefit and any other calculations for benefits elsewhere will go up 3% per year. So that again, we don't have to wait for general conference or anything like that. That will go up 3% per year. People who go on long-term disability will go out to Social Security to start to get their Social Security disability income as well. That takes a while to do. It could be 18 to 24 months. Their adjudication process tends to be 2 or 3 iterations before you actually get that approval. But once you are approved for SSDI, Social Security Disability Income, we'll do a dollar-for-dollar reduction in the amount of benefit that you're going to receive. But we keep you at that 70% overall. So that Social Security comes in, we offset, we bring down what's coming out of the plan, but we keep you at that 70%. And again, that amount's going to go up 3% per year, and all the associated contributions and benefits that's going to be associated with that will go up. And Social Security disability income goes up by a COLA each year as well. I think next year it's going to go up 2.5%. So it's not like a fix. It's going to continue to go up. Another thing is, depending upon the disabling condition, that whole paperwork dynamic is going to get repeated. So if it's somebody who's like severely disabled, it may be once every 18 months to 2 years. But other individuals, every year you may have to go through the process of getting all that paperwork done again. And, it's important to do that because we have to be good stewards of the program, the assets, the resources that are available. So we have those processes in place as well. Okay, and finally, resources. Again, we're in the process of modifying our benefits projections with the MPP 65% and the Compass that's coming down the line. When that is done, I'll let you know. Not quite sure yet how I'll provide that to you. I may just do a mass mailing. As time goes on, more of these webinars get done. I may just spend some time doing one big mailing or send out emails. If I send out emails, I'll send you out 2. One to let you know it's coming, and one to let you know that a funny word, ZIX, is in the subject line of that, just to let you know it's encrypted, and then you can get your documents that way. This is the way the document looks. Again, it's going to be some modification, but not a great deal of modification. But what you can see on the upper part of this is what you receive as lifetime income. What's coming to you in the forms of an annuity. And that's what you and your spouse cannot outlive. That comes to you in the form of an annuity. There are basic assumptions built into here in terms of benefit elections that you're going to make, account growth assumptions. That's all on page 2 and page 3 of this benefit projection. But for the annuities, we assume a life in 70%, 2% COLA, or a single life annuity with a 2% COLA. With the account balances, that 35% of the MPP you don't annuitize. The CRISP DC, the defined contribution, your UMPIP, we have account growth assumptions in there to the point of the date on the benefit projection is to the retirement date. And then we're assuming you're going to use life stage retirement income. But you have options on the screens. You can say, no, I'm not going to do that. I want to do this, and you can get that result. But when we just run them generally, we just do those general based assumptions, life stage retirement income. Later on, you make the change and you want to look at that MPP 65% as life stage retirement income. That 65% will drop down to the account balances area. So you'll see that over the course of the next several months. Then we have the income replacement ratio. This is just your Wespath stuff over your account, over your compensation. So the day, the projected date, then we discount it to the day we run it. What's your compensation? We come up with a percentage. This does not include Social Security or anything else that you have. So that's why you want to reach out to an EY Financial Planning Services organization or your own financial advisor, even your accountant to an extent, if they also do some investment services on the side, to understand how you can model all of your accounts to determine what your income replacement ratio is against your goals and needs heading into retirement. So with EY Financial Planning Services, they provide holistic household financial planning services to us at no additional cost to us. Operating expenses comes out of the funds. So we're all in the funds, we're all paying the operating expenses, right? So it's not free, but it's kind of free because we're not paying any money for it out of pocket. There's no limit on the amount of time you can use them, the number of phone calls. You can only do 5 a year or 15 hours. There's no limits to that whatsoever. Your investment in this is your time because you want to get, after you speak to them initially, they'll tell you all the materials, all the documents to provide to them. And that's your investment. Do that. Get everything set up the first time really thoroughly. Your Wespath information, you can give them access to your Wespath stuff. And you don't have to worry about doing that each and every time you meet with them. But your other things on like an annual basis, you may want to provide to them. Bank statements, investment brokerage statements, life insurance, those types of things. They will not try to sell you anything. So they're not going to look at any of the stuff that you're going to provide them outside of the Wespath world and say, hey, we can get you something better. They won't do anything like that. Common questions that you're going to see. Can I afford housing? How am I going to generate the down payment for housing? Those types of things. They can help you with the big macro pictures. Again, model what the income is going to look like. They know our plans. They know our funds, the provisions, the options, life stage retirement income, life stage investment management. They know the housing allowance tax exclusion. So you can work with them to really hone in on a good retirement income plan that works for you and your spouse, your household over the long term. So you can play with them, play with their software in terms of COLA percentage. Okay, let's go with the 5% on MPP with the 2% on CRSP. Let's do 2% MPP, 5% CRS. So you can do all of that just to try to take a look at how all that will come out and play. Now, the other thing is, we always talk in this context about the bigger picture type things, right? Financial plan, retirement income, tax efficiency planning, housing allowance exclusion, maybe a little bit of a Roth account, that's involved at the same time. But they're not there just for that. If you have an individual question around something financial, anything financial, you can call them up and speak to them about that. You want to set up an account for a child or a grandchild in a 529 plan? Do you want to lease or buy a car? Two of my colleagues both went out to them about that very question. They both ended up leasing in that environment. That was pre-COVID. I don't know if that would still be the result. However, they didn't know they were doing it, but they both went out for those types of things. How to deal with student loan debt, those types of, they can help you with those individual matters as well as the big picture matters. And then if you have a situation coming up where you need to get that $12,000 to do something, with the home or what have you, maybe you take a distribution, maybe you take advantage of the loan option. And that's pre-retirement and retirement. So that they're available across the timeline, the time zone that you have here. We have our one-on-one benefit education consultations. These started up just at the beginning of the pandemic. It was kind of being talked about as something we wanted to do, and then the pandemic came along, and we had to jump right in. We have a registration link that will be provided by email and in the PDF of this presentation deck. We have that. You go on, you register for 1.5 hour consultation with one of the benefit educators, myself, that's Todd, Cheryl Hatcher, or Bob, the manager, Bob Christopher, manager of benefits education. It's not a one and done type of thing. We'll go through your benefit access record. We'll run clergy service record and benefit projection before we get on the call with you. We'll go through all of that. If we don't get through everything or there's some follow-up that needs to be done, we'll just go ahead and schedule another consultation. This one doesn't have to be on the registration link. We can do this offline. Spouses are always invited to attend. But if you have a financial advisor, you're not using EY, you have your own financial advisor or a tax individual who wants to directly be involved in this conversation, they are more than welcome to come as long as you are on that call with them. We love to do these things. Certainly in the retirement season, we do far more than we do now. But we do hundreds of them during the course of the year, and we do enjoy doing them. So you'll have that available to you. And then, things to think about. Getting on benefitaccess.org. Again, we'll harp on checking your beneficiary designation. Just check what you're doing in UNPIP, regardless of the runway to retirement. Just get a good feel and view of that. If you have several years to go, maybe you want to make some changes. And again, if you know you're going to be in the Compass environment, start thinking about that 4% threshold for the full match. Look at how you're invested. Look at life stage investment management. Look at how we invest for MPP, how we set it up for your account balances. Or if you're self-managing, again, continue to look through all of that. We have the benefit projection tool. Again, it's being worked on, but that's going to be available. Again, EY, one-on-one benefit education consultations. And of course, our customer solutions area, the broad customer solutions area, I think it's 100 or so people that deal with all aspects of the benefits that are provided to clergy and lay employees. of the denomination. And then also we have that carve-out retirement team. I showed you the photo of them earlier. It is the same phone number. There used to be different phone numbers, but we commonized the one phone number there to the 851-2201 number. Then you just navigate to the retirement team, and they are there for you. So that concludes the webinar. And any questions that you have, certainly through Jamie and Azandra, you can come back my way. My contact information is also provided on emails, and you can always set up a one-on-one benefit education consultation. So with that, we hope to see you again down the road, and have a wonderful rest of your day. Thank you.